Brad Williams, Frugal Finance examples. Mortgage payment examples. I'm going to run through these quickly. I want you to work through these on your own. They're self-explanatory. There may be a few twists in here, but why don't we just take a quick look? Home mortgages. We'll keep it as simple as possible here and just do some basic Excel computation. You can work this out on your own using the annuity formula, but why? Excel has these tools to use them. Fully amortizing loan, points added to loan. We have a mortgage, 60 grand, 30 years at 12%. We've seen this before. What is the payoff after 10 years? We're going to use a new formula. We're going to use this present value, 12. Note what we're doing here. We're not using future value. That's what we're trying to figure out. So we're going to use 12, 12. We're going to try to find the 1%, 12% divided by 12. We have number of periods, and then our payment, which is going to be this 617, and that's going to give us the mortgage payment that's outstanding. Same loan with 3 points charged. What are we doing here? In that previous example, same loan with 3 points charged, 1,800. We're using 58.2 with 1,800 in fees. What is the APR? Well, we were looking at the payment. We didn't compute the APR. So what is the payment? $598.65. APR using monthly payment and true loan amount. What are we doing here? We've got the rates. Again, we're looking at rate. We're looking at C4, which is our monthly payment. 58.2. That is 60 grand minus 1,800. And we've seen this repeatedly. What is the payoff after 5 years? Well, all you have to do is go back to the previous two examples. What's the original loan amount? And then the payment if loan is paid off. This is exactly what we did previously. Mortgage payment, $450,000 loan at 4.5%. What's the monthly payment? Well, all we're doing is just changing the loan amount. What is the payoff after 10 years? Number represents years remaining to pay off. So 10 years, remember, what is the loan amount? Go back up here, and you're going to see it's 450 grand. So after 10 years, you've only paid off 90,000 bucks. Isn't that the beauty of finance? I mean, all that interest is going to somebody else's pockets. So, contrary to what anybody else says, if you can prepay, you can pay off your loan sooner. That's just more money to you. Same loan with 1,400 fees charged and added to loan. So loan is 450 minus 6250. This would be a 1.4 origination fee, for example. We have 2248.42 is the new as opposed to 22. What do we do? All we're doing is changing that loan amount to C17. Right here, 43. I cheated. Okay. So you get this 443,750. Then what is the payoff after 5 years? There's only one change we're making, and that is the number of the period, the timing. So you take 360 minus 5 years, which is 60 months, and what we're doing is just determining the payments. There's 300 payments left. 5-year prepayment, if loan is paid off before 5 years, what is the cost of remaining points in terms of yield? 483. Points of prepayment fees added to loan, what is the true APR? Again, this is practice, but you do this on your own because we've gone over it repeatedly. And why is this yield 13.25 as opposed to something higher or lower? Achieving a desired yield by adding fees. If you need a review, go back to the previous example and work through the numbers. What I want you to familiarize yourself is this structure here. Why is this negative? What happens if you do this? Change that. What happened? What happened there? Why just turned to 0? And why is that negative so important? So now we have a 14.10 yield. And what's C45? 61,523. What's C46? 57.5. So they're trying to compute a number. It's a positive number, and all you're doing is looking at a 61,527 and 57.5. The rate function just doesn't understand what's going on. Put a negative in here. You can see the impact. We've got to have a present value that is showing something that's due. Work through these, try to figure out the logic, or through practice, just understand the workings of the various tools within Excel. Mortgage payments. What is the monthly loan payment on 200,000 loan over 10 years? At 5% interest per month. Payment in arrears. Okay, what do they mean by this? We got payment 0.005 and 120, 200 grand, zero. Okay, you could see that we used an interest rate. We didn't divide this by 12, so just keep that in mind. All right, somebody may be sneaky here. So you're going 0.05 interest per month. So wording is critical here. What is the loan amount? Loan amount, if monthly payments are $22.40 at 0.5 interest per month. We're just using semantics here. Keep in mind how this works. Trying to find the payment. Keep that in mind when you're doing this present value stuff. We can reverse all this. So let's say we have a 10-year deal. We know the monthly payment and we know the loan amount. What's the rate? The number of periods equals. This is simple algebra using Excel. Value of a small building. We're just discounting this. Here's the deal. Cash flow. Small office rents for 25 grand for 25 years, 8% discount rate. What's its value? All we're doing is discounting this cash flow. And again, this is unrealistic because it's not taking into account inflation, but you kind of get the gist here. All we're doing is discounting this back for 25 years at 25 grand. We have a value. This is the beginning value and then paid in advance, 337, perpetuity, et cetera, et cetera. What is a small office building discount rate? Property is currently worth $2 million. It was purchased for $1.75 million with 25 years lease attached. What was the discount rate? What we're doing is taking this rate. Keep in mind when you're doing this that you don't always have to fill in the blanks. So here you have to think through the logic, look at what's going on here. We have number of periods. We're trying to find a rate. So why aren't we using the rate function? We are using the rate function. Why do we leave payment empty? Read here. Payment is the payment made each period. We don't need to include the payment in there in order to compute this rate. The value, what we're doing is we're looking at, notice the change, future value. So we have to look at, we're going to need a rate. The biggest concern or biggest question or the most frequent question I get asked is, how do I decipher present value, future value, or the rate or number of periods? The fundamentals. This method here is a shortcut. This is Excel. But go back to the basic math. Over here, I computed, using the annuity formula, how to compute the monthly payments. You're going to need to, if you're stumbling on figuring out the proper sequence, the logic here, go back to the fundamentals. What are we doing here? Well, we have the rates, we have the term, then we have the loan amount. Here, aren't we doing the exact same thing? If we look here, we have a rate, we have the number of periods. We know we're trying to compute this monthly payment. We have to discount the present value. So that's all we're doing. We're going to get the future value later. Then, if you need to figure out what the loan amount is, here's the algebra. It's been a million years since you've done any algebra, but break it down. We're solving now for X. What is X? We know we have this 2240. We're going to put 2240, that is our monthly payment. We're going to divide that by everything else. Then if you need to figure out the rate, we're going to have to do some little creativity here. The most difficult part here is solving for X, and X would be the term. Go back to the fundamentals. Or spend the time and work through the tools Excel provides. That's the only recommendation I have. That's the only thing I can suggest other than practice. What is a small building? Here we go. I just went back up here, the mortgage payment. But you can use this same math in every one of these problems. What should I pay for a leasehold interest? Think about what we're trying to do here. A leasehold interest sold for $230,000. The lease had 4 years remaining and rent was $6K per month. If we accept a monthly yield of 0.75%, what profit rent is shown by the transaction? All we're doing is, again, we're just using the exact same information, but keep in mind, we have a new notation here and we have a type. And type is going to give us if we pay the beginning of the month or the end of the month. Practice. An investor purchased a property for $1.2 million. The rent is $12,000 per month. If the property sold in 5 years for $1.5 million, what is the return? This is stuff that you may be familiar with. It may be a refresher. This is just the internal rate of return. You just need your cash flows. You need to know your beginning. So here's the outlay. Here are the annual cash flows, what the property sold for. Then you just use the internal rate of return, which is equals to IRR. All we're doing is capturing this information. It's that simple. 1354. If you don't know what IRR is, go to my future value session and I'll discuss this. Property value in 5 years. We're looking forward here. We're looking at trying to project future value, FV. We're going to use the same principle here based on the cash flow. We're going to determine what the future value is based on a rate. We just have future value. We have, looks like 1%, 5 years, $10,000 a month. And then we start off for 1.6 million. What we're doing is saying, hey, if I go 1.6 million times this future value, we're going to come up with 2081. Here is the proof. And what's that monthly interest rate? We're using the exact same stuff as we used up here. Mortgage loan payment. We're just going through the exact same methodology as I did up here. This is just practice. So mortgage loan payment. Here we're asking what the max loan is. We're looking at what is the monthly mortgage interest. Based off this number here, we're going to look at what is the monthly loan payment on a $366,000. Notice I wasn't asking here what the monthly payment is. We asked, this is the max amount I can afford. Give me the max loan amount. And then basically this is just proof based on the information provided here. All we're doing is substituting either rate, the annual, all we're doing is multiplying that times 12. We're going to use number of periods here, and then we're going to look for payment. So familiarize yourself with these. What is the remaining mortgage balance? What we have to look at here is how many months have been paid off. What is the monthly loan payment on $150,000? So we're going to look at monthly payment. We need to use that for present value. What is the rate? It says right here, 0.45. And what is the loan amount if you pay $1,900 per month for 97 months? $150,000. Interest rate on a consumer loan of $1,000 for 12 months with upfront monthly payments of $100. What is the interest rate? Think through this. Trying to find rate. Clearly we want to use rates. This is only for 12 months. You don't need to divide by anything. What's the monthly payment? $100. What's the total loan amount? $1,000. Remember the term here, 3.5%. That's monthly. That is egregious. That is robbery. Annual interest rate, all we're doing is multiplying that times 12. What is the monthly payment? If we have this 3.5%, we have the term, which is 12 months and $1,000, and it's $100. Change this to 0, see, beginning or the end. This is paid up front, paid at the beginning of the month, paid at the end of the month. We pay at the beginning of the month. If it was at the end of the month, it would be 103. How long? Well, this is just proof, the loan amount. 30 due in 15 mortgage with a balloon payment. You have a $300,000 balloon mortgage, 30 that's due in 15 with monthly payments on $100,000. 200K is due at the end of year 15. Monthly interest is 0.4 monthly. That'd be 4.8 annual. Payments are in arrears. What are the monthly mortgage payments? We have the 0 here. It means we pay at the end of the month. You're going to see 1580 if we put 1 in here. 1574, 1580. Notice there's a $6 a month difference paying at the end of the month. What is the monthly mortgage interest if you borrow? So this is just proof. What is the annual? All we're doing is multiplying that times 12. What is the remaining loan amount if you pay 1580.41 at blah blah? It's 202,880. How long would it take to pay off 300 grand loan if you pay 1580? There's 179 periods. Well, how much can you borrow if you can afford 3 grand per month for 10 years? You borrow 285. Typical mortgage loan with points, 375.2. We've gone through this. Now, what is the effective rate? 7.23. What is effect? Read it if you need it, if you're not familiar with it. But this is just a breakdown of a typical mortgage loan. It goes on and on and on and on. I just tried to show you a bunch of different scenarios. I owned a mortgage company for a zillion years. I tried explaining a lot of this to some of my clients, and trust me, they don't care. All they want to know is their monthly mortgage payment. So what you want to do is chime them into the effect of refinancing and when it makes sense not to refinance. And you can use these numbers and the previous examples to illustrate the trickery or the benefits of finance and just a slight change in rates. We're going to get into discounts. We're going to get into premiums. We're going to get into some other scenarios, but that's just a brief introduction to some loan examples. The goal here is to achieve maximum efficiency without abusing these rates. You'll understand that as we work through this. Brad Williams, Frugal Finance. Thanks for watching. See you soon.